The UK's 2025 budget may seem mild compared to last year's sweeping tax changes, but don't be fooled. Both the 2024 tax reforms and the latest round will prove painful over time. I'm Ben Simmons, the UK Regional Director at Blevins Franks, and welcome to our UK Budget Update.
And I'm James Green, Regional Manager for our UK team, and we're here to answer some of the key questions following the recent budget. The government may not have raised tax rates directly, but subtle changes or the lack of thresholds are having a major impact. So, what's really driving up the tax burden? If income tax rates haven't changed, why are people paying more taxes?
It's because the government has frozen the personal allowance and higher rate thresholds until 2031. So as wages rise with inflation, the tax bands will stay the same. More of your income will fall into the taxable brackets, and it's a stealth tax that's commonly referred to as fiscal drag.
And so, how many people are getting pushed into the high rate tax bracket?
Well, since the freeze began in 2021, 8.3 million more people have moved into the higher rate tax bracket from the basic rate tax bracket. And by 2031, they reckon another 5.2 million will start paying income tax, 4.8 million will enter the 40% band, and 600,000 will pay the 45% additional band. It's not just your salary though under pressure, it's a tax squeeze that extends into your savings, investments and pension wealth too. Rising taxes on savings, capital gains and dividends mean that investors and high earners are now contributing far more to the treasury than they once did. Many of the allowances that people relied on have quietly shrunk over the years.
So, how have the taxes on savings, dividends and capital gains changed?
Well, tax allowances have become far less generous. So savings allowances haven't risen since 2015-16. The dividends allowance fell from £5,000 in 2016 to £500. And the capital gains annual exemption has dropped from £12,300 in 2022-23 to just £3,000 from the 6th of April 2024 onwards.
And will pension wealth be taxed on death?
So from April 2027, pensions will fall into your estate, and they can now then face double taxation. So first inheritance tax, then the income tax on benefits received by the heirs. So this could mean up to 67% of the value can be lost to combined taxes. The tightening of this allowance just plays directly into one of the most contentious areas of UK taxation, and that's inheritance tax. So the frozen thresholds there and rule changes have meant families are set to pay even more.
The inheritance tax has been rising steadily for 2 decades, and current policies ensure the trend will continue. Frozen thresholds and new rules affecting pensions means estates would once have escaped the tax are now being pulled into the net.
Can you elaborate a little bit more on the figures as to why people will be dragged into the inheritance tax thresholds?
Sure, because the £325,000 nil rate band has been frozen since 2009 and will remain frozen until 2031. If it had tracked inflation, it would be around £517,000 today, dramatically reducing future tax bills.
And if I've got assets overseas, will that fall into my inheritance tax?
Much depends on circumstances. If you've lived abroad for 10 years, for example, and you've remained abroad, when you move back to the UK, those assets overseas would fall outside of the inheritance tax trap for 10 further years. For many people, property is their largest asset, and unfortunately, this is another area where the UK tax system has become less favourable, especially for investors and expatriates. The landscape for property owners has shifted dramatically. A series of tax rises, regulatory changes, and new reporting requirements have made UK residential property far less rewarding than it once was, particularly for landlords living abroad.
Why has UK property become less attractive as an investment?
A decade of tax and regulatory changes has increased costs and reduced profitability. Landlords now face higher income tax, capital gains tax and stamp duty, alongside reduced mortgage interest relief and tighter regulations.
What new tax burdens might property owners face?
Non-UK residents now pay tax on UK property gains since 2015. And from April 2028, properties valued over £2 million in the UK will be subject to a new mansion tax. The UK's tax landscape is shifting in ways that will quietly erode wealth over time. From frozen allowances and fiscal drag to harsher rules on pensions, property and inheritance, these changes demand proactive planning. Waiting until reforms fully bite could cost you and your heirs far more than you expect.
At Blevins Franks, we specialise in helping UK residents and expatriates navigate the complex tax rules and protect their wealth. Every situation is unique, so tailored advice is essential. Contact us today to review your tax and estate planning strategy and ensure your assets are structured as efficiently as possible for the years ahead.